Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Altice's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 958 million market cap. They're trading at $2.05 a share, and they have 467 million shares outstanding. Altice offers TV, internet, and telephone services to millions of residential and business customers. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow seems to be getting worse. It was $500 million in 2022. Now it's negative 83 million. That's not a good trend. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive 200 million to negative 160 million. Revenue is the sales for the company, and that goes down a little bit each year from 9.6 billion to 8.9 billion. What is going on with this company? They're doing the opposite of what they're supposed to do. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 2.1 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 467 million shares. And we get a calculated stock price of $357. They're trading at $205, so they're trading at a 43% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 40 companies in the same industry as Altice, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a good amount of capex, $1.5 billion. AT&T spends the most, $21 billion. The reason telecom companies have a lot of capex spend is because they have to build out the infrastructure for their services. The landlines, the cables, those telephone poles. All that stuff has to be created by these companies. The number one reason people invest in telecom companies is a dividend. AT&T pays 5%, Verizon almost 8%. Look at Vodafone, 10%, Cogent over 10%. But this company doesn't have positive free cash flow, so they cannot pay a dividend. This type of business brings in tons of cash flow. Look at Verizon and AT&T, 20 billion of free cash flow. Even Vodafone's pretty high at 12 billion. The Canadian company Telus, 1.3 billion. Altice is a really small company, under 1 billion market cap. AT&T is a giant, over 200 billion. Altice has really poor ratios. We can't look at their price to book. Price to book is stock price over book value per share. They have negative book value. You cannot have a negative price to book. The way a company has negative book value is when their liabilities are higher than their assets. We can't look at their PE, they have negative earnings. When a company has negative earnings, that means the expenses on the balance sheet are higher than its revenue, and they have negative free cash flow. So we can't look at their price to free cash flow. The nice thing about price of sales is it can never be negative. You can't have negative sales. You could have zero sales, but you can't have negative sales. You could always have a price to sales ratio. They're at 0.1, which is pretty much the best you can have. That means their revenue is 10 times their market cap. They have the best price to sales on this list. They do generate a lot of revenue, nearly 9 billion. That's more than a lot of companies on this list. It's bigger than the number 4 company, Chunghwa Telecom. Chunghwa is a Taiwanese company. They're a pretty young company. They were founded in 1996. But the Taiwanese government controls about 35% of the company. It's a big company, over 20,000 employees. You can see from this chart, Altice is not growing anymore. Their 5-year annual revenue growth rate is negative 2%. Look at Liberty Broadband, positive 131%. They're growing like gangbusters. Altice is currently trading between its 52-week low and high, almost right in the middle. AT&T is trading really close to its 52-week high, only 1% off. Chunghwa is trading right at its 52-week high. Same thing with Liberty. They're trading pretty close to their 52-week high, 87% above its 52-week low. Look at Lumen Technologies, 324% above its 52-week low. That would have been a good stock to invest in. If you put $10,000 into this company when they started trading in 2017, you'd be really, really sad. At 666 today, a 93% loss. At one point, you would have been up. That was probably in 2021, the post-COVID surge. So to summarize, I have them trading at a 43% discount, ranking 6 out of 10. I think it could be a good short-term trade, 7 out of 10. It looks like it's trading at a good point where you can make some profit. On a long-term basis, I'm not too sure. I probably would not invest long-term because it seems like the stock keeps going down. So that's 3 out of 10. Ratios look really weak. A really nice price to sales ratio, but it almost looks too good to be true. And financials are really weak as well since revenue is going down, so that's 3 out of 10. Let's take a look at their latest 10Q. We'll start with their income statement. Here's the first quarter of 25, first quarter of 24. Revenue is down a little bit, 2.25 billion to 2.15 billion. Let's see if they give a breakdown of the revenue. This income statement gives a lot more detail. Here's the revenue to 2.15 billion. 900 million of that revenue was broadband, which is down from last year. Broadband just means high-speed internet connection. It's inclusive of Wi-Fi, fiber, satellite. Their video revenue is down a lot as well, 755 million to 665 million. That's probably down the most percent and dollar-wise. Telephone went from 71 million to 66 million. Mobile is up. That went from 25 million to 37 million. At least something is up. Their business revenue is almost identical. 365, 363. News and advertising is pretty similar also, a little over 100 million in both time frames. Then you have other revenue. That's up from 12 million to 18 million. So total revenue is down about 100 million, down 99 million. They do have positive operating income, positive 340 million, down from 390 million. Here are their expenses. Programming and other direct costs, 700 million. Other operating expenses, 700 million. Lots of depreciation and amortization because of all the fixed assets they have, all the CapEx spend. They have a ton of debt. They spend 428 million of interest on their debt. So they have a net loss of 72 million. Last year was a net loss of 13 million. But just because they have negative net income doesn't mean they have negative cash flow. We'll look at the statement of cash flows in a little bit. Here's their adjusted EBITDA, if you're into EBITDA. So it starts with their net loss on top, and then you add back the I for interest, T for taxes, D for depreciation, A for amortization. So interest, 428 million, depreciation, amortization, 418 million. So you add those back. So they do have about 800 million of EBITDA. And they have positive operating cash flow, positive 188 million, less than half of last year. But they spend more on CapEx than they have in operating cash flow, so they have negative free cash flow. It was positive last year, positive 64 million, but this year it's negative. Here's their balance sheet, 32 billion of assets, current assets 769 million, current liabilities 2.2 billion, so really poor current ratio. Current ratio is current assets over current liabilities, and that's about a 0.3. So they could only cover 30% of their current liabilities with their current assets. Their big asset are the franchise rights. Those are the rights to deliver their product, deliver cable and internet to their customers. They also have a lot of goodwill, 8 billion. So that's 21 billion right there, those two. Also PP&E, 8 billion. So those three are pretty much all their assets. Let's see if they give a breakdown of the PP&E. I didn't see a breakdown of it. Let's look at their liabilities, 32 billion of liabilities. So liabilities are higher than their assets. That's why they have negative equity. Look how much debt they have, 25 billion of debt. That's why it's a penny stock. Here's a breakdown of the 25 billion. Lots of debt, lots of notes. These are when the notes are issued and this is when they mature. And here's the interest rate. So on this $2 billion note, they pay 5.75%. It matures in 2030. So they have a ton of debt out there. Look at these notes, over 11% interest. This is getting close to 12% interest. $2 billion. So this company may be headed towards bankruptcy. They also have a credit facility. They pay 7%, 9%, 9%, nearly $7 billion in that facility. They have LightPath senior notes. They must have did an acquisition of this company, LightPath. You can do a quick Google search. Is LightPath part of Altice? LightPath is jointly owned by Altice and Morgan Stanley. So it looks like it was a joint venture between Morgan Stanley and Altice. That's how they acquired LightPath. So if you want to learn about LightPath, the company offers internet, Ethernet, dark fiber, Wi-Fi, private network, and voice services. It looks like they mainly serve customers in the US. Let's go back to the balance sheet. Assets minus liabilities equals equity, negative 526 million of equity. They have a negative accumulated deficit. Accumulated deficit is a sum of all their prior net incomes minus the sum of the dividends they paid out. That's why their price to book is NA, because they have negative equity. Here's their statement of cash flows. Positive 187 million of operating cash flow. Last year was 400 million. This is just for the quarter, the first quarter of 25. The reason they have negative net income and positive cash flow is depreciation and amortization. It was over 400 million. That's a non-cash item that brings down your net income, but we add it back here in the statement of cash flows. They spent a lot on CapEx, 356 million. CapEx spend is not just growing your business, it's also maintaining what you currently have. So this may all be maintenance. Here's a breakdown of the CapEx, 120 million of customer equipment, 113 million of network infrastructure, support 66 million, business services 54 million. They do give you more information down here if you want to learn about the CapEx spend. The last section on the statement of cash flows is the financing section. They added 450 million of long-term debt, a lot less than last year. Last year was 3 billion. They repaid 220 million of debt. So that's how they funded their CapEx with the debt. The difference between 450 and 220 is roughly 200. And they use that 200 along with the operating cash flow of 187 to fund the CapEx of 356. Let's take a look at the company on Simply Wall Street. Its last price 205, 958 million market cap, down 9% in the past week, down 2% in the past year. Here's the stock price since 2017. It looks like it started out at $30. It didn't do that bad the first few years. It came down to the low teens, then back up in 2021. Its peak was almost 38. But ever since mid-2021, the stock has fell off a cliff. It went from 38 down to $1.60. Here's the stock in the past year. It was trading below $2 for a while in 2024. It did jump up to over $3, but now it's coming back down to a little over $2. This looks like a really tough stock to invest in. It's hard to really know when to buy and when to sell. They say the stock is 84% undervalued. Here's their future free cash flow estimates. They're projecting the company to grow a lot in the future, up to 870 million of free cash flow by 2034. That's why they think the stock is so undervalued. And they have a pretty high WACC, 11.6%. Here's their revenue since 2014. It was 6.4 billion. It did get up to over 9 billion in 2017, but it hasn't really grown much since then. It did come up a little bit, but then back down. So it's been pretty much flat the past 8 years. There's been a lot of insider selling by the founder of the company. It seems like every week he sells stock. 1.6 million shares, 800,000, 800,000. He sold a lot in the 20s, but he also sold some in the 2s. I wonder how he sold it in the 20s when it was never that high. I mean, in December 2024, it wasn't in the 20s. 58% of the company is owned by institutions and 42% by insiders. The founder owns 40% of the company. The next biggest shareholder is Vanguard, 2% by Bracebridge, 1.5% by Hudson Bay, and Cerberus owns 0.8%. They're a private equity firm. Their employee count has come down from 14,000 in 2014 to 11,000 currently, and the ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.